Alright guys, we are back with another video. Today I'm going to go through a couple problems in chapter 5 and chapter 6. Okay, I lied. One in chapter 5 and then two in chapter 6. My nose is a little stuffed up, so I'm sorry, but you know, we got it. So basically, coming into this first one, let me get out of my way. Got a little highlighter here. This color sucks. We're going to do purple. So, this thing's all up in my way. Renner Hardware Store completed the following merchandise transactions in the month of May. At the beginning of May 2027, the ledger of Renner showed a cash of 5,000 and uh owner's capital of 5,000. So, hold on one second while I charge this headset. It's my brother's and it died on me and it was really loud. Wonder if that'll be in the video. Probably not. Anyway, that's charging. So, scroll back over. Here we go. So, starting out, hold on. We have cash 5,000 and then owner's capital is also 5,000. So, no. So this is May, at the beginning of May, yeah. So to journalize these transactions, I'm just gonna make it real easy. We're gonna do May or 5/1 tab over. Yep. Oh, we get a table in here. Perfect. Purchase merchandise on account. Okay, so we got purchased on account from Bronze Wholesale Supply for 42,000. Terms 210 net 30. So we are buying merchandise. So there's going to be two transactions, I believe. Or yeah. Or one transaction. And we're going to debit inventory because we got money or we got inventory for 4,200. And then we're gonna credit accounts payable because we purchased it on account. We're gonna credit that for 4,200 if I can put the numbers in. And then that's it for that one. Our next transaction was May 2nd. Sold merchandise. Okay, so we're gonna come up here and we're gonna get our little highlighter. And it was hello, sold on account for 2,100. Terms 110 at 30. So we get 1% if we paid off, or they get 1% and if they paid off within 10 days. The cost of the merchandise sold was 1,300. So that cost right there. There we go. So back over here. We sold merchandise on account. So when making a sale, there are two entries required. First, we recognize the revenue of getting or of making that sale. So we're gonna debit accounts receivable because they owe us money, okay, for 2,100. Let me put that comma in there. Hello, 2,100. Taking this money sign out. I don't want to keep doing that. And then it's sales revenue. Sales revenue because we made a sale for 2,100. But also on that day, the second half of our two accounts are to record the expense of selling that stuff. So, what account does that go in? Cost of goods sold. What type of account is that? A expense account. So it's debited for 1,300. Well, that is inventory because we no longer have it because we sold it. We don't have the right to the inventory anymore for 1300. Moving on. May 5th, so 5/5. Received credit from Bronze Wholesale Supply for merchandise returned $300. So we get our money back or our credit back because we purchased it on account from this purchase right here. Let me draw a little arrow. We get our money back from that. For merchandise returned of $300. So in making a return, we just almost do the reverse of this. So, or actually, you know what? It is the reverse of that. So we're going to debit accounts payable because we no longer owe them that money for that $300 worth of stuff. And then we are going to credit our inventory. Don't know why my caps lock is on. Inventory for that $300 because we no longer have the stuff. We sent it back. Okay. This thing will get out of my way. Received collections in full, less discounts from customers billed on May 2nd. So that, if my little Zoom thing would get out the way, that over there is this purchase on May 2nd. So they received it in full, or we received it in full, so May 9th, and they get that discount, the 1% discount. I don't have a calculator, hold on. Calculator open. We're gonna do that. Oh, it's why does it why does it look like that? How do I get rid of the history? Because it's okay, there we go. This is a little funny looking, you know? You know, if it works, it works. So we are getting rid of that whole accounts receivable. So that's gonna be our credit. But okay, so they had a 1% discount, so 2100 times that 0.01 for the percent is $21. So 2100 minus 21 is 2079. So our cash that we get is 2079 or $2079. Sorry guys, I'm taking a minute to think. And then we are crediting, or just kidding, we have another debit, which is sales discounts for that $21. And then it'll work for once. And then we credit that accounts receivable to fully close it out or just fully get rid of it. Let me zoom out a little bit for that whole 2100. Okay, guys, are you following? Let me scroll back over a little bit. Paid bronze whole supply in full, less discount. So that is this transaction. And no, just kidding. We didn't buy any more inventory. So that's just this transaction right here. So this transaction is on May 10th. Paid bronze wholesale supply in full, less discount. So that is 210.30. So we come over here to our calculator and we do 4,200, well, 4,100 since, nope, 3,900 since we returned $300 of their stuff times 0.02. So we get a discount of $78. Okay. And that is going to be, that's added to our or subtracted from our inventory. So that's going to be one of our credits. But we purchased it on account. So our accounts payable will be debited and decreased because it's a liability account for that 3,900. And then to get into our credits, we're going to do cash for 3,822. Yeah, that makes sense. And then we credit our inventory because when we take a discount as a purchaser, it's just credited to our inventory because this it reflects the cost of what we bought it for $78. Next one, the 11th. Purchase supplies for cash for 400. So we're debiting supplies for 400 and we're crediting cash. That was pretty straightforward. I hope. 400. Next one, purchase merchandise for cash for 1,400. I'm actually gonna, can I like decrease this size? I'm like zoomed in pretty far. You guys can still read that, right? Let me get rid of the lines draw. No lines. There we go. Is that a little better? Make that even smaller. All right. I gotta sneeze. Hold on. Okay, there we go. May 12th. We purchased merchandise for cash for 1,400. So we're gonna do inventory because we made a purchase for 1,400 and put that comma in there. And then for cash, should have done this in Excel. Sorry, guys. I'll probably like turn the video off and then move it to Excel. Okay, and then the 15th. So 5/15. Received $150 refund return or received for poor quality merchandise from supplier on cash purchase. So that's this purchase right here that we just did. So we're gonna get cash back. So it's $150. So we get that cash back. And then my thing will fix itself. And then we return the inventory for $150. Next one, May 17th. Purchase merchandise on account. So let's go back to full screen real quick. So we purchased merchandise on account for 1,300. Terms 210 at 30. FOB shipping point. So the cost will go to us, but that's in the next transaction. So we can ignore that part for now. All right. So we purchased merchandise on account. So our debit is going to be to inventory because we bought inventory for 1,300. And then, well, it'll work on account. So we're going to credit accounts payable because we bought it on account. And we owe them that money. And then the next one is for that shipping freight. So it's going to be, well, I can't remember. Do we pay the freight, right? Chapter 5. Buyer accounts inventory. as freight. Okay, because it's part of the cost to get it, I think. So it's gonna be $130. So we paid it, so we're gonna just credit it to inventory for 130. I believe I'll double check that in a second. For cash, 130. I will check that real quick. Look at that memory. Woo! Okay, May 24th, we sold merchandise. So sold for cash 3,200. And then the merchandise sold had a cost of 2,000. So we made a sale, so we're gonna have two entries just like last time. I'm gonna go ahead and drop that down. So first we recognize the revenue. So we made the sale for cash. So we're gonna debit cash for 3,200. And we're gonna credit our sales revenue for 3,200 because we got that revenue, got that bag. And then the merchandise sold had a cost of $2,000. So we're gonna debit that to cost of goods sold for $2,000. Did I read that right the first time? Look, I'm going into like psychosis or something. And then we take that out of inventory because we don't have the inventory anymore. Because guess what? We just sold it. And that's that. So May 25th, 5/25, purchased merchandise on account from Lumley. So we made a purchase on account for 620 terms 210 net 30. So we're gonna debit inventory for $620. And then we're gonna indent that or on account, so accounts payable for that $620 also. May 27th, paid Valley distributors in full. So let's go back up here. Up here. Paid Valley distributors was the 17th. So less discount. So we got the discount we paid within the 10 days. So again, it's gonna be like what we did up here on the 10th. So we're gonna debit accounts payable because we no longer have that liability for the whole 1,300. And then our credits are going to be to cash for what's the discount? Hold on. Should have done that first before I started yapping. So it was 1,300 times 0.02. So $26. So 1,300 minus 26. 1,274. So our cash check is going to be 1,274. And then our other debit is going to be to inventory because we didn't what am I trying to say? It reflects the cost of what we paid for it. Did I even highlight the right one earlier? I did, didn't I? Anyway, for that $26. Moving on. May 29th. Made refunds to cash customers for returned merchandise $70. The returned merchandise costed $30. So here again, it's a refund. Well, it's a refund. So there's going to be two entries. The first one is to retract that revenue, but we don't retract it necessarily from sales. So that account that it goes into is sales allowance or sales RNA, so returns and allowances, if I can spell it right. Okay. And then it's cash. We're getting cash back, right? Yep. For $70. Well, wait. Do we get cash back? Let me pause while I figure out what I did. Can't remember. I'll be right back. All right, guys. Definitely did that right. I was tripping. It's a customer. So, yeah, we have to give them their cash back. And then we record the expense side. So, we're getting our inventory back. I really can't spell inventory today, guys. For $30. And then we just take that back out of our cost of goods sold. 30, not 300, Lord. And then our last one is May 31st. Sold merchandise on account. Get out of my way. Zoom thing. Sold merchandise on account for 1,000. Terms net 30, so they don't get a discount. The cost of merchandise sold was $560. So again, it's a sale. So we are doing two entries. So it's on account, so accounts receivable for $1,000. And then we're crediting sales revenue. Sorry, that's my phone going off. For 1,000. And then also on 531, here's that second side. So we record the expense. So cost of goods sold is the expense attached to inventory for 560. What a profit, guys. And then inventory for 560. And real quick, I'm just gonna maybe I can just do it on camera. Excel. Auto fit. Date, let's change that real quick. Custom. Okay. Let's make these a little bigger. Okay, so here are all our things. And real quick, we're gonna highlight this. And I'm pretty sure. I can't remember. I think we have to post these to T accounts too. Let me make those real quick. Wait. Okay, guys. I journalized all the stuff and did the little like running balances. It's also in the little solution thing that she posted. So here's all the things. Anyway, continuing. Now we get to make the income statement. Yeah. List of accounts. Da da da. And then your through gross profit. Whoa, profit for the month of May 2027. So we are going to come over here. And we're going to do our little header. So Renner Hardware Store. Income statement for the month ended, whatever, for the month ended May or 5/31/27. Right. Yep. And I must drag that over Alt H across. Let's go up here and center it. All right. So I'm gonna open my notes up real quick. Accounting, chapter 5. So down here, this is our uh this is our income statement for a merchandising company. We have our sales, less our sales discounts, and less our sales returns and allowances. And then that equals our net sales. So I'm going to go ahead and format that out. So we got sales, and then we got less sales discounts, less our sales returns and allowances. And then we got our net sales. And then we got less cost of goods sold. And then that is our gross profit. And then we didn't have any other operating expenses in this problem. So, yeah. So, back to our little problem. Well, actually, just kidding. Hold on. I'm going to fully open Excel over here. Open. There we go. Okay. So, our sales revenue is right here. This ending balance right here. Let me zoom in a little more. Hopefully I can see all this. So our sales, let me drag this over. Yeah, Alt H across. Our sales was 6,300. And then I'm going to go ahead and type in negative. So our sales discount down here was $21. So we're going to do minus 21. And then our sales returns and allowances was minus 70. And then we're going to do equals sum, and then click and drag all that, and then close that parentheses. And then our cost of goods sold was, did I even do that one? Yeah, I did. Hold on. Cost of goods. I just didn't retitle it. Sold was 38.30. So 38.30. And then we're gonna do or negative 38.30. Hold on. Negative 38.30. And then sum these two. And then let me format this a little bit. So, I didn't do like any of the the numbers. Yeah, this is a partial one, by the way, because we don't have our operating expenses. So partial, partial. Okay, so bottom line. Bottom. Gonna make all these bold. And then this gets a double underline. So our gross profit is 2,790 or I can't read. 2,379. And then through the gross profit. So that's all that problem. I just skipped all of the adjusting or not the adjusting entries. Oh my God. The journalizing because it was a lot of yeah, it was all this just put into these tables. So you got I know y'all understand the posting to the ledger. Anyway, moving on. We're gonna go down here to problem 6. Can I like crop this? No. Order, bring to front. It's like a little bit better. Okay, whatever. Determine the items and amounts to be recorded in inventory. So, let me get my little highlighter. We're gonna close that. Houghton Limited is trying to determine the value of its ending inventory as of February 28, 2027. So, the company's year end, the following transactions occurred, and the accountant asked your help in determining whether they should be recorded or not. So, hello. I was about to say, can I get my stuff? Okay, so on February 28th, Houghton shipped goods costing $800 to a customer and charged the customer $1,000. The goods were shipped with terms FOB shipping point, and the receiving report indicates that the customer received the goods on March 2nd. So, FOB shipping point. By the time those goods leave our dock, we don't have the title to them. So they should be off our books and recorded. So the following transactions occurred. Well, yeah. Duh. So A, it'll be, oh, why is it so big? Janet. So part A would be, well, can I get a table, actually? I forgot how I did that last time. Insert table. Uh, we're just gonna do that. Yep, that works. I'm not gonna do the dates. It's just like piece by piece. Okay. So we made a sale or shipped the good. Yeah, we made a sale. So that's inventory, no. That's accounts. Well, maybe cash because it doesn't say on account for 1,000. Well, it's inventory. Okay, hold on. Maybe we don't need a table. One second. Okay, so we have less $800 of inventory. Doesn't matter when they received the goods. It's, yeah, you know. On February, wait, that's not included in inventory. If any should have been recorded. Okay, whatever. On February 28th, Crane Incorporated shipped goods to Houghton under terms FOB shipping point. The price was $450 plus $30 for freight. The receiving report indicates that the goods were received by Houghton on March 2nd. So, doesn't matter when we receive the goods. Let me get my little highlighter back in here. Okay, so $450 plus 30 for freight. It was FOB shipping point. So when they leave the dock from Crane Incorporated on February 26th, we own those goods while they're in transit. The receiving report indicates that the goods were received on March 2nd. That does not matter. So we get $450 of inventory plus that $30 for freight. Or plus 30 for freight. But that also goes into inventory. Because it's also in the cost of getting that inventory, you know. Houghton had 720. Am I dyslexic? Houghton had $720 of inventory isolated in the warehouse. The inventory is designated for a customer who has requested that the goods be shipped on March 2nd. So assuming that it's also FOB shipping point, you know, everything else has been. We still have those goods because, you know, they haven't been shipped. So I don't know if they're bought yet, but $720 stays on books until shipping. I'm just gonna write that. Y'all know what I'm trying to say. Also included in Houghton's warehouse is $700 of inventory that Korenic, whatever, producers shipped to Houghton on consignment. So we do not have ownership of those. This on consignment down here, if I can get my highlighter, this on consignment, this company right over here, Korenic Producers owns these items, okay? So we don't have ownership. We might have them in our possession, but we don't have the right to put those on our books. Continuing down, let me drag this down. On February 26th, Houghton issued a purchase order to acquire goods costing $900. The goods were shipped with terms FOB destination on February 27th. Houghton received the goods on March 2nd. So up here, February 28th, 2027 is our year end. And since this down here was FOB destination on and we received the goods on March 2nd, these don't get put on our books. So yeah. Okay, we don't let me just write that. Own that 700 of inventory. And then this one down here, let me do some. There we go. We cannot write that on our books. So FOB destination, we don't yet own goods. On February 26th, Houghton shipped goods to a customer on the terms FOB destination. So get our little highlighter back. So we shipped goods to a customer under FOB destination. The invoice price was $390. The cost of the items was $240. The receiving report indicates that the goods were received by the customer on March 2nd. So yes, we would record it. Or no. Yes. Yes, we still have the goods because as of February 28th, we still have ownership. So we record on books. So less 240 out of our inventory account. Part G. Houghton had damaged goods set aside in the warehouse because they are no longer saleable. These goods originally cost $400, and Houghton had expected to sell these items for $600. Well, doesn't matter what we expected them to sell for, they're no longer sellable. So that would be something inventory write down. Loss on inventory write down. Something along those lines. Let me go back in my notes. Can't remember. Where's that? Write down. Hello? Chapter 6? When did we do that? Write down. It was the iPhone problem, right? Where'd it go? Where's the iPhone problem? That shrinkage. Am I tripping? Oh, it was right here. Yeah, loss on inventory write down. So the difference between the loss of inventory write down is that the goods are no longer sellable. So this right up here, inventory reported as current asset at the lower of cost or net realizable value. So they claimed that our net realizable value was 600. Or like what they would sell it for. they're damaged and you can't sell them for that. So expected to sell these items for 600. They originally cost 400. Can't do that. So, and then you do, or you subtract the inventory nope, $400. Yeah. Is there like a beginning balance? Houghton. Hold on. Oh, we don't have the solutions for these. Hold on. Mm-mm. Well, pooey. I wish you would post it. Files. Oh my lord. Miss Cole, please. Why is none of this organized? Oh, that's it. Yeah, she really doesn't have anything else. Yeah, that's about it. Okay. Hold on, let me go back in my book and, and see what this problem is. I thought I took a picture of the whole thing. Whatever. Flipping through my textbook. What page was it? 48. Oh, look at there. I flip right to it. What problem we on? 6.1? Yeah, we on 6.1. It doesn't give us a starting thing. Am I tripping? Hold on, let me go back and look at the other problem that's mentioned in it, I guess. Oh, well, never mind. I don't know. Okay, but basically that is like how you determine whatever. Does it really not give us a who owns it, what account? Whatever. I don't know. Okay. I'll be right back. I gotta go. Yeah, I'll be right back to do problem 6.2. Yeah. Okay, guys, I'm back. So, yeah, sorry guys, had to potty. Anyway, um, okay, that's that. Guys, I can't really tell you what else to do on that one. But these are the reasons, you know, for all 6 parts. That was six, right? 1, 2, 3, 4, 5, 6. Okay, well, what am I missing? Destination, we know all the goods. Am I? Oh, 7. I just can't count. Fire. Okay, 6.2. Let's change that font size back down. Let me get my highlighter. If this thing, okay, get out of my face. Let me get my highlighter. Callie, quit that. Tearing up the carpet. Okay, Glee distribution markets CDs of their performing artist unique. At the beginning of October, Glee had beginning in wait. Did we already do this one? No. Did we? Yes, we did. Okay. Just kidding. We're not going to do that one. We are going to do problem 3, right? Yeah, we're going to do problem 3. Just kidding. So, what are these company names? Had a beginning inventory on January 1st of 160 units of product at a cost of $20 per unit. Okay, we're actually going to go to Excel for this one because I don't want to hand do all that math. We're in a new sheet. Okay, so we have our dates. of purchase. We're gonna have our dates of purchase. Periodic inventory system, so not perpetual. So we have March 15th, July 20th, July 20th. Did I just do that completely wrong? March 15th, 20th of July, 4th of September, 2nd of December. Okay, let's move that down and in a little bit. Sale date. Move down actually. This is our beginning inventory, so B our big in beginning inventory was 100. Okay, we're gonna do units, cost per unit, and then total of that. So total of whatever's available. So we had 160 units of whatever at $20 per unit. And then 400, 250, 330, and then 100, 26. Nope. 23, 24, $26, $29. And then this is our totals. So our total units. Okay, wait, I messed that up. Parentheses. Okay, total units available is 1240. So we're gonna make that light blue. And then equals. Oh, wait. Okay. And then here's our total of, or like total cost of goods available. Okay. So in FIFO, first in, first out, we sell 1,000 units. So for 1,000 units, so first in, first out. So 160 plus 400 is 560 plus 250 is 810. So we gotta stop at this 330. Let me get this calculator back up here. Whoa, not that big. Anyway, we have our 160. Or actually, yeah, 160 plus our 400 plus 250. And then that's 810. So 1,000 minus 810. 1,000 minus 810 is 190. So out of that 330 needs to come 330 needs to come 190. So 140 is what we sell out of that, right? Hold on. Let me make sure I did that right. 12,400 minus. Yeah, so what should be left in our inventory is 140. So 330 minus 140. So we sold 190 units out of here. So we sold 1,000 units. So from the first one, all 160. From the second one, all 400. From the third, all 250. And then 190. And then what we should have left, ending inventory, is 240 units. And then we'll calculate the ending inventory for each of the other things. So under FIFO, we got all these numbers down here. We're going to paste that. And then copy the thing over there. Okay, so our total like inventory that we sold was 2334. So total or cost of goods sold. Yeah, that's what it is. And then our uh what's left in here is, well, Loki, I can't pay attention half the time when she moves so fast. Six. Okay, well, our ending inventory, get back, should be, so we have 100 of this left, and then 140 of this left. So we're going to do EI. So 100 of 29 per unit, and then 140 of 26 per unit. Let me just copy this actually. And then some parentheses, these. So hopefully you add this and you add that. And down here in the bottom, the sum is 2988. So that adds back up to this number right here. So this is our ending inventory. And I'll make that red, I think. Actually, we're going to make it orange. So there's FIFO. And we're going to do it all again for last in, first out. Make that bold. Again, we sold 1,000 units. So, but instead we'll start at the bottom. So 100 units at 29 per unit. And then only 80 will stay in there. So 330 at $26 per unit. 250 for $24 per unit. And then what did I just say? $80 will stay in there. So 80 minus, or 400 minus 80 is $320 at $23 per unit. We're going to paste over that little formula thing. Our cost of goods sold is 2482. I got a bug crawling across my screen. So, and then what to calculate our ending inventory, so EI, we have 160 units of our 20 per unit, and then we only have 80 of our 23 per unit. And then again, I'm going to copy this formula over because I don't want to do the math. And then we're going to copy that formula over. And it'll do that math. So our ending inventory should be 5,040. And if you select both of those, or select both of these, it should come out to 29,880. And then for our weighted average, we're going to do the same thing, basically. So how to calculate weighted average is your total cost of goods available, right? So 29,880 divided by how many you have available to sell, right? Or is it how many you sold? Pretty sure it's how many you have available to sell. Oh, I gotta sneeze again. Yeah, total cost of goods available to sell, and then total units. So we have 12,040 or 12,140 units. So 1240 back to, if the Zoom thing would go away. Oh my Lord. You can't see the Zoom thing, but it's there. Teaching. Okay. Anyway, back to this. So to do that, I will get my calculator up. So to calculate our average cost, it's 24 point. We're going to do 24.10. Okay. So our cost per unit, we're going to do CPR or CPU, cost per unit, is, what did I just say? I can't remember. I got like short-term memory loss. Equals this divided by this. You round. How do you do it? Two? Yeah, there we go. So this is our unit cost per unit. And then we sold 1,000 units. So multiplying these, so you do 24.1 times 1,000. That number is 200 or 24,100. Again, we're going to make that red. So that's our cost per unit. And then what else did I want? Oh, it said 3 decimal places. So there we go. 2497. 24,970. Which cost flow method results in the highest inventory amount for the balance sheet? That would, of course, be. Oh, wait, we didn't do ending inventory. So 1 second. EI. And then that's not supposed to be red. That's our cost of goods sold. No fill. Why is it red? Get out of here. Our ending inventory this is our cost of goods sold. Ending inventory, we have 240 units at this number. And then we multiply these. So this is our ending inventory. Sorry, I messed that up, guys. So our most, let me go back over here. So which cost flow method results in the highest inventory amount? Highest inventory amount for the balance sheet would be first in, first out. And then the lowest cost of goods sold would be for, well, the lowest cost of goods sold is also first in, first out, isn't it? Okay, so cost of goods sold, yeah, 23,340, 24840, and then 24097. Okay. Highest inventory amount for the balance sheet. Oh, highest inventory amount for the balance sheet is first in, first out. Or inventory amount, it's all the same thing. Same many units. Oh, no, don't ignore me. It is first in, first out. The lowest cost of goods sold for the income statement, isn't it also first in, first out? With the lowest cost of goods sold? It is. Definitely. And that's about it, guys. That's literally it. That's all the stuff right there. I didn't make any of these number format, so forgive me. But okay, I'll highlight them real quick. So the units are gonna be green. Units are gonna be green. Okay, yeah, all the units are green. And then you're multiplying across by the cost per unit. We'll make that purple. We'll make that purple. And then yeah. So cost per unit here is that per 1,000 units is that green. And then cost of goods sold, make that bold. I'll make all of it bold actually. Okay. That's about it, guys. That's all I got. Let me know if you want me to work more problems. Yeah, that's it. Good night.